Hello. Oh, great. Hello. Sorry about that. Hello and welcome to today's Wealth Builders webinar. I am so glad you joined us, and we have got the one and only Billy Epperhart right here in studio with us
Right here
today.
live. I'm with you today.
Isn't that
It's a modern
amazing?
day miracle. We're together.
It really is. And he's going to be talking about a 2024 Q1 market update. And we've been visiting here a little bit, and I'm telling you, Billy's got some great information. So I just want to welcome all of you. We are so glad to have you. We've also got Pastor Mike Davis on. Mike, if you want to greet everybody.
Glad to be here. Looking forward to hearing from Billy.
It's going to be good. And of course, we've got the Wealth Builders Conference that is coming up. It's already next weekend. Can you believe that?
I can. It got up here quick, didn't
It got up here quick, and we are so excited. Many of you are registered, and I actually have some exciting news for you. We've been sold out in the VIP portion of the Wealth Builders Conference, and we were blessed where the hotel upgraded our room.
Wow.
So we have just added 20 VIP tickets. So those of you that are registered and you wanted to get in on the VIP, what you can do is email us at info@wealthbuilders.org, or you can call us, and that phone number's right there in the chat for you, and we'll get you upgraded. And those of you that have not yet registered, I want to encourage you to do so. Billy, this is going to be the best Wealth Builders Conference ever.
Man, I'm looking to it, and I really feel like I've got some real specific things to say this year.
All
Again,
right.
at Wealth Builders that the Lord's really been downloading in my heart.
Oh my goodness, I can't wait. I call that fresh manna.
Yep, fresh manna.
Wow. So if you want to get registered, go to wealthbuilders.org/events. And again, in the chat, there's going to be some links. All right. Oh, this is great. You're all trained. You're already telling me, like, hey, where you're tuning in from. We love that. So let us know where you're tuning in from. I'm going to give you some shout outs here. We've got David is on from Delaware. Welcome, David. We've got Paul that has joined us. Shelly, hello. Welcome. I'm so glad that you joined us. You are on a lot, and we're so appreciative of that. We've got Paula joining us. Welcome. Laura Wardlow. Hello, Laura. She said fresh manna. She's excited about that. And of course, Laura's in our coaching family. We've got Linda tuning in from Kansas, Chris from Salina, Texas. Welcome. We have got Mark and Jen. Oh my goodness, from Nashville. Hello, our Sweat Shack friends. We're so glad you joined us. And then we've got Nairobi, Kenya is on today. Wow, Billy.
Wow.
We've got Z showing up here from Durant, Oklahoma. Lori from Colorado, another coaching family person. We're so glad to have you. Pablo from Plano, Texas. Kim, good to see you from Texas. Paula from Loveland, Colorado. Dennis joining us from California. Herbert and Ebony, welcome. Wow, it's so good to see you on, and you're tuning in from North Carolina. We've got Bobby from Oregon. Oh, Christina from Richmond, Texas. Billy, this is amazing.
Yeah, they just
Angela
keep
Rose
popping
is
up.
on today.
Wow.
So good to see you, Angela. It's like, family day,
Yep, it
right?
is Family Day. That's awesome.
It's awesome. So we'll continue to do some shout outs. Keep letting me know where you're tuning in. Larry, I see you coming in from New Zealand. Gary from Lakeland, Florida. We're just so glad to have you. Also, just a reminder, we've got Charlie and Jill on as well from Florida.
Hey, Charlie and Jill.
This is awesome. We
That
could
is
just greet
awesome.
everybody,
Just
you know.
greet
and-
everybody. That'll be the weapon.
yeah, just catch up with you all. This is wonderful. It's still coming. So Uganda's on, Natasha from Chicago, another Wealth Builders coaching family person. This is wonderful. So I just want to remind you that this is an interactive webinar, and so we're going to be taking your questions. Billy's going to share 30 to 40 minutes. We'll answer as many questions as possible, and I know you are all excited to hear from Billy, and so Billy, I'll turn it on over to you.
Well, Karen, you've asked me to do an economic update for this webinar, and so I really have some things I think that are important for us to know and recognize. And before I get into some detail, it has some of the things I'm going to share sound very similar to actually what I've been saying for the last 2 years, except I'm going to actually give some specific updates right now for where we are today, but the general trend. And so what I want to do for a minute is I want to start at kind of a 30,000 foot view level of some things that are happening out there. And then I'm going to come down, and my favorite part is I have a couple of charts today
All right.
that will help us kind of gauge
Yes.
a few things. But I want to start kind of at that 30,000 foot. And the first one, when we start talking about this, is just when we talk about here in the U.S., and I realize that we have people, of course, from around the world that watch this even live right now as well as later. So with that recognized, when I talk about things in the U.S., if most of what I say will translate to the majority of Western nations. And one of the things that we've all been dealing with around the world, and of course here in the U.S., is the higher interest rates.
Right.
And for most people, it would be the higher mortgage rates when it comes to real estate that we've been dealing with. And so what has happened is that what we call the Fed, which is basically the central bank here in the U.S. that controls two things. It controls more than that, but the big two is that it controls the money supply that's actually coming into the economy. That just simply means the amount of dollar bills that are printed. And then it also controls the interest rates that we're dealing with. And so, if you're alive and breathing today, you're probably aware that interest rates have gone up. And so the reason they have is because inflation, we have been dealing with inflation now coming out of COVID into 2022. Inflation just took off like crazy. Yeah. And so now, since the rates have gone up and the Fed has raised those rates over the last year and a half very aggressively, it has began to cool down what we would call the rate raise. So the Fed raising rates. And so now what's happened though is that what's affecting even the stock market today and what's affecting real estate today is that what has happened is that most people have thought that the Fed, the central bank, is going to lower rates in March of this year, which is just a month or so, less than a month away from the time we're recording this. And I don't believe that's going to happen. I believe what's going to happen, some people right now are saying the market is pricing it in for May. I think it's actually going to be in the fall.
Really?
And so what's going to happen to real estate and even the stock market, you may see the stock market itself, which I'll talk about in more detail, slow down a little bit because we're hitting new highs right now. And but what has happened is that I think there's going to be a delay in Fed lowering rates. So I want everybody to hear that. Even when it comes to mortgage rates, the new mortgages that people need are going to be up a little longer. The interest rates are than what some people think. The other thing that we're dealing with right now that I don't talk about a lot when I'm doing these updates is we're now at a $34 trillion U.S. debt that we have in the U.S. And the truth is that even just this last week, Jamie Dimon, J.P. Morgan, he addressed, just this, so I'm talking about right now, he addressed the national debt as being a weight that is on the economy generally. And the reason I'm bringing that up is because then Jerome Powell, the Fed chairman, he echoed the same sentiment. Usually that doesn't happen. And so what it's saying is people are starting to wake up that we don't hear the national debt talked about a lot, but it's 34 trillion. So with inflation going on and we see the economy heating up and has heated up, it has now, just so I'm bringing the update properly, it has slowed down. And so basically we're seeing inflation at around 3%. Some indicators are somewhere in the high twos is where we are on inflation. So that part of it slowing down has been positive. But most people who pay attention to these things think it's going to be longer. It's going to take longer for the Fed to actually get that down in a consistent 2% rate, which simply means that mortgages for homes and other things are going to be up longer. Wow. Okay? So if they do I'm going to make sure I get this in. When they do a rate lowering, I think it's only going to be 0.25%. are 25 basis points, not 50 basis points or 0.5%. That has been priced in really to most of the markets that are out there, including the stock market. So it's going to be slower. It's going to be a little bit softer. And just remember I said that. I really, now here's what's going to happen. I think we are going to get a 25 basis point reduction because the election is in November. Okay?
That's what I'm thinking
So
too.
what I'm thinking is that that's going to happen, and I think they're going to do it to try to help Biden get reelected.
so,
I
too.
think that's going to be part of it. But so we're talking about this, this kind of where we are now. Now,
Can I ask you a question
Yeah.
quick before you go on? So you were saying that the interest rates, the reduction has already been built in the market.
yeah, in what we see in the value of commodities. So when we see it not in commodities, in the value of securities. So when we see it's in the value of commodities as well, but it's in the value of your bonds, what you see priced into your bonds.
Okay.
And really it's priced into the stock market. And one of the reasons, and I probably wasn't going to talk, I appreciate the question because I probably wouldn't have brought this up. But what's happened with the stock market right now, what you're actually getting on returns, all people see is the market is up, right? And they go, oh, the market is up. What they don't realize is the cost of what you're having to pay for the market right now. So for example, if you bought an index, the cost of that is the price to earnings ratio is too high right now. And so actually, are you ready for this? 90-day bonds paying 5.39% right now, 5.4% right now, are giving us a better return than some of the high-flying stocks if you were to look at how expensive they are and what your return is back on them right now. You're actually making more on bonds. So what that's telling us is that we still have a problem with several indicators. One, it's overpriced, which we'll look at later real quick. And then also there's still this inverted yield curve that's out there, which always predicts a recession. So there's this weird time that I've been talking about in the economy that we're still in. We're just updating it today. And I'm talking about the debt for the first time. So there's just some weird things floating in the economy. The other one right now, what most people don't talk about, is that we're in a global economy, and right now China has lost 7 trillion. I mean, that's a staggering number. They've lost 7 trillion in the value of their stock market, and their entire commercial real estate market has absolutely imploded. I mean, as we're seeing, so their commercial real estate market has imploded. I mean, it's bad. And then the actual stock market they have there, the values of what they have gone down since beginning of 2022 into 2021, have gone down. That market has gone down by $7 trillion.
Why do you think that is?
Well, it's because of this weird time that we're in, and first of all, they overborrowed, number one. That's the biggest thing that happened with commercial real estate.
Okay.
It was in China. It was so highly leveraged, and they were overbuilding, right? So they didn't have people to take the properties that they were building. And then high interest rates came in, and people who might have bought some of them couldn't buy them because they were priced out of the market. But then China has tried to make some moves that have not been smart, and their securities market, not just real estate, but has really reflected it. So they're taking a bath economically.
Wow.
So that could back up over here as well.
And impact
And
us.
so we're talking about some things kind of out here right now.
it's really
but
interesting.
just to kind of let you know. So that's why when you're looking at buying real estate or you're looking at investing, you have to stay with your rules and your principles of how you're investing and watch for it. So for example, right now, if we talk about interest rates, let's say for real estate, if we look, they came down for 30-year owner-occupant kind of mortgages. They came down in the real high 6s. Then they went back up into the low 7s. They've come down again. Now they've gone back up. And so what's happening is when you're buying that piece of real estate, you just have to make sure, if you're borrowing money, that it has to cash flow, right, based
Yes.
on the current rate that you're dealing with. That's
Yes.
just the secret sauce.
Yeah.
Right? I
It
mean,
is the
it has
foundation.
to be disciplined. But what happens is the inventory of the real estate market is getting hammered. Even though it's starting to loosen up a little bit, it's still hammered because people are not going to let go of their mortgages at 2.75, 3%, 3.25,
So true.
and even those at 4%. And they're looking at the current rates. They're going, I'm not doing this, right? And so the point is our inventories are still really low. And so you really have to look
Yeah.
harder to find properties. It used to be low-hanging fruit, right?
Yeah,
Now
if I
it's
can
not.
just let people
Yeah.
know too, we talk about the ratios and we cover that in depth. You'll hear about it at the Wealth Builders Conference. We cover it in depth at the real estate workshops, but it's also in your strategic real estate investing book. And so if you are interested in real estate, that would be an amazing source for you to start to read. And Billy details all those ratios.
Yeah, and I think as we look at that, in those ratios, as long as you hold, like I had someone call me about 2 weeks ago, and who I've known for a long time, and they go, hey, I'm doing a 10, they're not in the program, but I've known them forever. And they go, hey, I'm doing a 1031 exchange on something I sold commercially. I want to roll into a house, and they were concerned that they weren't going to get the 1%, right? And I said to them, well, let me ask you a simple question. I said, okay. I said, are you borrowing money in this? I'm assuming you're paying cash. You're just rolling over your gains. And they said, I am. I said, well, then don't worry about the ratio absolutely here. What you need to do is, first of all, worry about the property you're going into. Make sure you're getting a solid property, long-lasting, solid property that has a good rent rate that's coming in, and you're not going to have a lot of vacancy and repair kind of work that you're going to have to do. As long as you're covering it and what you're rolling in, and here's what I told them, and I said, as long as you're able to make the positive cash flow on return. Now, it would be too much for me to do it probably on here to explain it, but I explained to them how, if they could get a 6% return on that property, in the year, and I'm including vacancy and repairs. And I said, and we got to talking, and we discovered they're going to get, based on my calculations, they're going to get an 8% annual return on that property, and I'm not including the normal appreciation that comes. So I said to them, it's a no-brainer. If that's you got a good quality property, you're going to get an 8% return on your investment, not including the appreciation on the property.
Wow, that's great.
That's a no-brainer. And so I said, here's what you want to do. That's pretty high, actually.
That's really
just so
good.
we're clear. And so, meaning the 8% on the money they invest. So I think right now, and I didn't realize it was going to be that good. I told them 6. So I think right now, you may have to think a little different because of where rates are. But if you're doing a 1031, that's a whole different
Yeah.
animal.
That's
So anyway, just to deal with a little
Thank
bit of
you.
real estate.
Thank you.
So one of the things I think right now, let's put up the one, my favorite one, which is the Buffett indicator on the stock market, and then I want to talk a little bit about that. And if we can, do we have that coming up?
It's coming up there.
Yeah, there you go. Thank you. I'm gonna have to. I don't know if I'll look good on my camera here, but I'll look over here. Can we? Is it possible to move that for a second?
It
There you
is.
go. I can see it right here.
Okay,
So on the Buffett indicator, this is one I use in all of the workshops. I'll use it again, possibly at Wealth Builders, or I know I will here at the Men's Advance here at Karis Bible College. But one of the things that I just want you to see there, if you could go with your cursor, or whose cursor are we using?
We've got
Gabriella's?
Gabriella's.
So Gabriella, if you just take your cursor way to the right there and go all the way over, up, right there. And if you look, bring it right there. If you go right there with it, you'll see that what we talk about being overvalued, where the stock market is right now, it's above what we call the one standard deviation, which means that where the market kind of hangs around is that dark black kind of big larger dotted line there, and it'll be lower than that and above that. But if you start getting above the one standard deviation, which we did in 2022, look how high the market went in 2022 compared to what we call the Buffett indicator. And the Buffett indicator is simply the price of the S&P 500, that index, the S&P 500 index, compared to the gross domestic product, and the way he divides that, and you can see, and I think it's the most classic way to tell if it's valued. And so you can see that it's above the one standard deviation, and you really don't want it below that, because I want you to see something here. I mean, above that, I'm sorry. You don't, anytime it goes above one standard deviation for any length of time, look what happens next. And we're going back here to 1950. So if you watch it, Gabriella, you come back over there and just follow the blue line, and I'll tell you when to stop. If you'll just follow the blue line, just follow. Yep, there you go. Go. Keep going right there. And then let's go to the high mark here on that one. And you see where it starts reaching up. Go to the next one, to the next high point. If you go right there, we're in the late 60s, right? Mid 60s, mid to late 60s. And you can see when it got up to standard deviation, look how fast it came down. Now, it only stayed down for a little bit, but it went right back up. And then look what happened when it went above the standard deviation right there, over in about 1975, when it went above the red line that's there, it fell. See how far it fell?
Wow, big
Then
fall.
it came back up, and watch this, because I'm going to show you something. It came back down again. Look how far it came down. It came almost came below the one. Gabriella, you need to come all the way over to 1970, if you would, for me. That right there. It came, now go back up, follow it back up right there. Now follow it all the way down. Go all the way over. No, the other one, the other down line. There you go. To the right, to your right.
Keep going.
Keep going. Miss Karen, there you go. Look how far it went.
Wow. So that had to be a crash.
So, yeah, so when you're looking at this, we're going in the late 70s when everything got overpriced, right? It was,
Interest rates through the roof.
well, interest rates started, because these aren't right. Interest rates didn't start going up again till 1980. And then in 1979, 1980, they went through the roof. You got up to 18%.
I remember that.
Remember that?
My dad
But
was in banking.
You got it. So look how long the market stayed down there. See how it stayed below
Yeah.
even the dark black line. You see that? You see that?
Long
And
time.
so if you look, there's some similarities to today. Now, I'm going to tell you why I'm going back to this chart today. There's a reason besides just doing it because I've done it before. Okay, there's a reason. And the reason is, and I have this here, is that just this past week, and let me see if I can find the notes I put in here today. And what happened is that the majority of the stocks, we have the Magnificent Seven in the stock market. Those are the ones Google, Nevada, Microsoft, Apple, Tesla. The Magnificent Seven, they're the ones that are pulling the market up. But I want you to hear this now. This is worth the whole webinar to recognize where we are today. The last time that we had more losers in the stock market, more stocks that were losers in the stock market, and the stock market still went up. So where the majority, watch this now, where the majority of stocks were down in price, but there were only, in our case we're talking about today, a handful of stocks that were pulling the stock market up. The last time that happened, so we're in February of 2024. What I'm describing to you has happened at the very end of January and this week in February of 2024. It just happened. The last time it happened was Black Friday that happened in the fall of 1987. So the last time, so the point is, you say, Billy, what's the point? The point is the stock market itself, as I've been saying for every time I talk about this, it is kind of a temperature gauge of where the economy is. And for this to have happened right now in the week that we're actually doing this webinar is a big deal. And so the point for us is we need to watch it and be aware of it. And very candidly right now, again, I'm very reticent on the stock market. I saw where Jim Cramer, who's on TV talking about the stock market, he's telling us that when rates go down, make sure you invest in the stock market. I'm not sure that's the best advice because right now we're out a little ways from rates even going down. And secondly, I think we're kind of in a scary place with what's happening in China.
Yeah.
And what now? I will say this: I think as long as the interest rates are solid and good, meaning what's going to happen in interest rates, that real estate itself, residential real estate, 1 to 4 units right now, if you buy it right, is still one of the best investments you can get in.
Wow,
And
that's good to
that's a
hear.
big statement.
That's
right?
a big statement.
And the reason is because you control whether you're buying it right? You
Yes.
control for whether you're buying it right. Now, I want to talk about crypto and some other things as
Great.
we look at this. And crypto, Bitcoin specifically, and crypto generally has gone through the roof because of the uncertainty of what's happening right now in the market out there. And there's a lot of voices. There's not just 2 or 3 that are warning that crypto's overpriced because of the kind of economic situation we're in. Now, crypto has gone up because of what's happening, partially because of what's happening in China. And so people are looking for places to go. But right now, when as I've said many times with crypto, Bitcoin, I like the technology behind Bitcoin, but I don't like the fundamentals that cryptocurrency itself has no intrinsic value. You buy a piece of real estate, I can buy it, I can live in it, that's intrinsic value.
Yes.
I can buy real estate, I can rent it, that's intrinsic value. And so when it brings value, for example, like it does to the marketplace, then I'm actually seeing I have intrinsic value in that. So one of the things, so people say, what does all that mean? First of all, you got to be cautious right now and aware of what you're doing. I've recently just bought some more gold. And so I buy gold, and it's strictly a defense. I don't buy gold to make money. I buy gold as a defensive posture, and I have a lot of that and a lot of silver. However, on the flip side of this, I just want to say that I still think that there are opportunities. If you use the formulas that we teach, there's still going to be opportunities. There are just not as many of them in real estate right now because the inventory is still so
tight.
low, right?
Yeah.
And so, and just so everybody knows, I still have some exposure to the stock market, so I don't want to misrepresent.
Yeah.
I also use fund money to buy some crypto, so it's not like, but I don't have any real money in crypto.
Yeah. You
I
said
have
you'd be okay losing it.
No,
is
and
what you put in.
honestly, I because I'm at a place where I can do it, I have enough money in there. I've made some money, right? But the flip side of it is, you know what happens, then you wake up tomorrow and go, where did it all go, right?
Yes.
And so, whereas in some of the other assets that we teach on and talk about a lot, there's values in there. So I probably ought to stop right there. I actually have more stuff, but I think right now that's a pretty reasonably comprehensive view to some degree of where we are in the economy right now.
Wow, this is great. We're getting a lot of comments here, a lot of people saying interesting. Here's a question from Simon that says, which direction will the S&P 500 go?
Yeah, so I actually think, and I've been saying this actually for 18 to 24 months, that we've been in this weird season of time with the S&P 500. I will tell you right now, there's more warnings coming out on it being overpriced than we've had in probably the last 6 or 7 years. And it's because of how far it's gone up coming out of COVID and other things. So right now I will say this, if you want to invest in some dividend paying stocks, those are more defensive for your investment for the stock market. Then those kind of approaches, which I have some of that, those kind of approaches are okay with the stock market. It's just, you have to be aware and don't put the majority of what you have in it. You can put some of what you have.
Yeah.
Now, if you've got a long-term horizon, now I sound like some of the normal advisors out there. If you have a long-term horizon and you want to ride it down, then you can do that. It will come back up in time once the economy gets more stable. And honestly, with the election, if the right person gets in at the election, then what'll happen is it may take a year or so, but we'll see that market really begin to get much healthier than it is right now.
Wow, so interesting. And just a reminder that Billy's going to take some questions. I see some of you are submitting those, but go ahead and enter those into the chat section if you're watching on Zoom. And if you are joining us on Facebook, go ahead and put those questions in the Facebook comment section, and we will answer as many of those as possible. And what we don't get to, we'll do a podcast where we'll try to get those answered, just to get you the information. And of course, a reminder, the Wealth Builders Conference, you're going to hear a lot more from Billy and the speakers. We have workshops that cover a business track. We've got the real estate track, we've got an investment track, and if you're part of the VIP package, you actually have access to very small hands-on sessions where a lot of the real estate coaching people that are on here today will be a part of, and you'll be able to have some, really strong interaction. So to learn more about that, go to wealthbuilders.org/events. All right, wow, the questions are really coming in here, Billy. So let's start with Winnie. She says, is this the right season to buy a home with the high interest rates?
Well, the classic answer we always give with that is that if you can afford it, yes, and then the next part that helps you is rates are going to go down, and so then you can refi into lower rates when they go back down. And so just so everybody understands this, the standard interest rates, and this is worth the price of the ticket right here if you understand this. Historically, the price of interest rates that you use to truly value real estate is somewhere in that 5.5 to 6.5 range. So the point is, if rates come back down to where you get a 5, what's going to happen is the value of real estate and then what it costs to borrow the money to get the real estate, there's a level of equilibrium somewhere in there. So what happens right now, if you're able to buy at a higher interest rate, then the price of the housing, it's possible, can get a little bit, it's already getting softer. We're sitting today in Woodland Park, Colorado, my other home in Lone Tree, Colorado. I'm seeing those prices begin to get softer. And so the point is that when it does come up, first of all, they stay on longer, typically. Secondly, there's not as many people looking because not as many people can afford it. And so you have a little more time. When it's in this manic that we came out of in 2022, you may have 25 offers on a property in the first 3 hours it's listed. You don't have that anymore. In Colorado Springs, which is not very far from here, we're not seeing that either. And so I think right now the inventory being low has still kept prices a little bit firmer, but they're definitely coming down. So if you can afford it, right, you can afford the monthly payment with over here in the back, you can refi later.
So good.
Then I wouldn't be afraid to buy it.
That's really good. And just hit those ratios that we talk about. And if you can do it in this interest rate environment, then when the interest rates
It'll
go
get better.
down, you just improve your cash flow.
Yeah, because you locked in the price by already purchasing.
Wow, so good. All right, this is from Charlie, and Charlie says, so you said that the 90-day bonds are at 5.39%. Is still a really good investment. 9-month bonds at the same rate, is that still good?
That becomes the issue, Charlie. That's where the inverted yield curve still is. I mean, it has been, that inverted yield curve has been really ridiculous for as long as it's been. And I know people are looking at that. I'm talking about people that are a lot smarter than I am. They're going, man, how long can this stay this way without some kind of mega echo effect? And so I think right now, short-term bonds are still the way to go. And there's obviously, number one, there's a safety effect to that. And I know I'm familiar with some of Charlie's stuff. And so I think right now, like if you can go to a CD, not a bond, you can go to a CD and lock in the rate. There's still some stuff out there that's in that 5.5 to 6% range, and you can lock that in right now for a short period of time, a year or less in the CD. That's probably a safe way to go if somebody's just wanting to be safe.
That's really good. I'm just curious, when was the last time we had the inverted yield curve?
Well, we have to go back to, I think it was in the 1980s. I know I've shared that and talked on it, so I want to get the big one happened in the 80s, and then we've had one other in the recession we had coming out of '08, and we had an inverted yield curve where we had that recession. This one has lasted a long time, longer, just because of the weirdness of it, meaning the weirdness of nobody knows where the economy's going or what's happening. And so right now, because of that, and it's primarily been affected this time just because of trying to tame inflation, which was the same thing that Reagan was trying to do in the 1980s. But the point is anytime there's an inverted yield curve like we see right now, there always has been 100% of the time a recession that followed. And we felt recessionary effect, but we haven't seen it at a level that we're calling it that at this point.
Got it. Thank you for that. All right, James says, what do you have to say about growth stocks?
Well, right now with growth stocks, those are the ones that have a tendency to be the most risky to come down. So your growth stocks and the Magnificent Seven, as they call them, that I'm talking about now, which is pulling that whole stock market up, those Magnificent Seven are definitely growth stocks because you've got Apple in there, right? You got Microsoft in there, you got Tesla, I mentioned, you got Amazon in that group. And so you have Google in that group. So all of those tech stuff, the Nevada, I call it's Navita or something they call it. But if you look at that one is really, it's a true technology company. Those are the ones pulling everything up. And what happens is when the market takes a hit, they're the ones that go down the first. That's why we say dividend paying stocks, which are even different, can be different than value stocks, because some value stocks are dividend paying stocks, but not all value stocks are dividend paying stocks. So if you find dividend paying stocks, then you're getting a return on your stock, as long as the company declares the dividend, regardless of whether the market's up or down, right? And so the dividend is paid on the number of shares you own and the dividend they declare, not just the value of your stock.
It's kind of like collecting rent.
It's like collecting rent. And matter of fact, that's a great illustration.
Yeah, you really helped me with that, and this may help some of you too, is when we were getting into real estate, you were explaining that when you've got your rent coming in and you pay attention to that cash flow, which is really important, you've been talking about that. If the value of the property goes down.
Doesn't change.
Yeah,
Usually rents go up.
it doesn't impact you.
No, and rents tick up.
Yeah.
So it's amazing. And if you do it right, you don't get over leverage where you're always under the gun. But if you get a healthy balance, then it's mailbox money.
It's so good. So good. All right, Deb has got a great question. She says, is now a good time to build new builds? For example, cabin kits, vacation locations. What do you think about new builds?
Yeah, I think it is in this context that those that are providing those kits are the builders that are going to build. They're not getting a lot of business right now. So there's an opportunity because money's tight. So because of that, there's an opportunity to negotiate, get better deals, get better time frames. So for example, if you were paying cash, or even if you were paying half of what you're doing in cash, for example, then it's a good time. If you're going to go up to 80%, then you have to meaning you're going to have to borrow 80% or 90%. Then you got to go, okay, how much is my money costing me to be able to do that and still negotiate these good deals with the builders to do it? So from that perspective, you can get better deals because money is tight. I used to have friends that kept, we call it keeping your powder dry. They'd keep their money over here, their cash, and when the market would start really stalling, I'm talking about like for example, I haven't talked about commercial real estate right now, but we're getting ready to take another bath, especially in office real estate. A lot of banks are exposed to that. But the point is they would keep it, and then they would negotiate with all these contractors. to build buildings and things they were doing, and they would get just screaming deals. I mean, in some case, 50 cents on the dollar because they were just trying to keep their crews busy and keep them working. So
Hang on to 'em.
So if you know what you're doing, you can be wise. Yeah, you can do better right now.
Yeah, that's great. And they oftentimes own a mortgage company, so you're able to actually get,
Well, on the new builds,
Yeah.
so with the new properties that are being built, Gabriella knows this.
She
it's on
does.
Zoom,
That's what I was thinking
that,
of.
That if the new builders are negotiating on the prices, but they're also the ones that have their own mortgage companies, they are providing these 30-year rates that are less than 5%.
amazing.
And it's locked in. It doesn't adjust in 2 years or 3 years
That's
or 5
amazing.
years. It's locked in for 30 years. So if you're buying, so you're getting a decent price on the house. You're getting a really good interest rate right now.
Yeah.
And so because of that, I think those deals are good deals.
Yeah, that's great to look at. And there is a fair amount of new builds around right now.
There are a lot of
I
new
noticed
builds.
that on MLS.
And the reason there still are a lot of new builds, so everybody understands, is because the inventory is so low.
Yeah.
They've got to build. There's more demand. It's just not, the availability of money has not matched the availability of demand.
Oh, so good. All right, Dennis has a great question. He just wants to know in general, and he's on Facebook. Thank you, Dennis, for joining us. What does the renters market look like, and is it worth it right now to get in the game?
Well, it is, because the renters market is still strong. Because always remember this, when people aren't able to buy a house, they still have to have somewhere to live, right? So I see in some markets where people are talking about rents beginning to come down. Where that is true is where people were charging maximum rents in 2022, where rents were really high. But if you kept your rents in a general value level, like, I have some properties and you just keep them up, I always keep mine somewhere in that 75 percentile, not 100%. And then what happens is your rents just keep ticking up for you. Now, people who were just gouging or really overcharging, some of those rents may soften a little bit. But typically, in times like this where people can't buy, rents still tick up because people still need a place to live.
That's really encouraging. This is a great question from Lori. Lori, thanks for this. She says, I bought an investment house at the peak, and her variable rate, she's in a variable interest rate, was low. The bank advised her to ride it out. So when rates went up immediately, she is now not in a positive cash flow and the house has lost a lot of value. She says, what should I do? Should I ride it out with a good tenant, or should I sell at a loss? And she is paying the taxes out of pocket.
Well, and I think the answer to that is going to depend on what their total tax situation is, right? And so what I mean by that is right now, it might be an advantage to selling at a loss depending on how that may or may not help you in your taxable situation. If it's not going to help you in your taxable situation, say, for example, on your 2024 taxes that you'll be paying in 2025, for example, if it's not going to help you, then what I would do is I would look at writing it out, except I would have to see how much that negative cash flow is, right? And then we'll have to run kind of an analysis to say if I'm going this long, and it's going to cost me X amount over here, the net present value of the sale may be worth more now than writing it out for it to go up. And I'd have to look to see how much it is, how much that loss is.
So it's not the same answer for everybody, is what
Right.
you're saying. There's a lot of
Right.
factors to consider.
No, and the truth is that negative loss on a cash flow for her that could help her on her taxes, having a negative cash flow going in to the year. She'll have to look at that specifically. For most people, right now, depending on how much that loss is, probably selling and taking the hit is a good way to go because of where probably because I heard you say she bought at the peak.
Yes.
And so right now, for us to get back to the peak of 2022 is probably a 3 to 5 year period, it could happen in 3 years. I mean, I honestly believe that. So it could get back to those values in about 3 years. So, but I don't think it's going to do that before that. So that's another part of that answer.
Yeah, that's really helpful. And Billy, why are some markets actually increasing yet year over year and other markets are softening?
Well, right now, the reason some of these markets are actually increasing right now, again, is because of demand. In other words, what's happening, because the general monetary and cost of money that's out there, but what's happening is the demand, so it means they're either popular locations people are interested in. It's primarily those reasons. But I know that some of the popular destination areas in this current time have taken a hit. But if you look at that peak that we showed you on the chart for the Buffett ratio, that peak is the same you saw in real estate as well.
Yeah.
So real estate went up. I mean, luxury watches hit a peak in 2022, and right now some of those watches you can buy for half. I didn't buy them at peak. I watched them at peak, but I'm not going to buy at peak. And I'm watching them, and now just because there's an index, there's a Bloomberg index on luxury watches you can watch, and it has come down. So luxury items, those that had value, were the same. Real estate was the same. Stock market was the same. It all hit the peak in mid 2022 is when it hit, and then we softened in 2023. We're coming into more softening, and honestly, I've been reading some of the latest reports on real estate, and I think it was one of the chief economists, First American Financial Corporation, said this guy was predicting a flat stretch ahead for the 2024 market. So, for example, he said the 2020-21 housing market was too hot. And really, into 2022, it was too hot.
Really hot.
And then the 2023 market was probably too cold. It was soft, right? And so we're in that softness, but 2024, he said, won't yet be just right. In other words, it's going to maintain the same of what we've been in 2023. So if you bought at the peak, that part is a little bit tough.
Yeah,
but
especially when you're not cash flowing.
yeah, especially if you're not cash flowing. So I think the minimum you're going to see that as far as rates or interest rates, if you did adjustable rate, interest rates, is you're going to have a 3-year ride as well to even see prices come back up.
Wow. Okay, very good. Lots of real estate questions here. Angela Rose. Hello, Angela. So glad to see you on. She said, how do you know when it's time to raise the rent with a tenant?
Well, I think, first of all, if you have a good tenant.
Yes, that's important.
So what I do is I go to, one of the ones I subscribe to, and our many of the clients in the Wealth Builders real estate area, and coaching clients and those they subscribe to all kind of services. One of them I use is called Renometer.
Yes.
And I look at the median price of rent for that, and I will raise it according to that. Sometimes if it's been a really solid tenant that's been in there for a period of time, they've paid on time forever, I might go into a new year and not raise it. But most of the time I raise it right above that median level. And that's what I do. I stay there, and I don't ever try to gouge a tenant, especially if I have a good tenant.
Yeah,
Right?
that's
And
good.
so really good tenants you want to try to take care of. So those are the kind of things I think that you look at. You don't, if you're going to play the top of the rent game, if you're going to play the top, your turnover is going to be really high.
Yeah, and 1 month of losing rent
That's
can
correct.
wipe out all that increase of
And
rent.
believe me, I speak from years of experience having a ton of properties across the place. And if you're, even if you have 10% of your properties and you've got a lot of them that are sitting out there vacant at one time, let me just tell you, I'd rather have that steady income and make sure and raise the quality of my tenants in everything I do. The fact that we haven't taught that a lot in the deal, but that's like, conducting an orchestra. You've got all these, and you want to play that game where you manage the quality of the tenants you have.
So good.
That's a big deal.
That is a big deal. And Michael, this is a great question that goes right along with it. He says, with rents being so high, do you believe we need to be concerned about them coming down?
Well, I think right now, if you're in that 50 to 75 percentile is what I'm calling it, for rents in the zip code that you're in, and you're in that ratio, then I think you're solid. And if you're closer to 50, right, which is what I try to do, and you're still getting good returns. Now, I realize that we have people that are buying homes, they're borrowing the money against the houses, that kind of thing. And so, if you're probably above an 80% loan to value, you may be trying to push that rent up in order to be able to collect, right?
Yeah.
And probably even more than a 70% if your purchases are recent. So I think right now, it may be a little bit harder, but I just wouldn't get above that, 70, 75% percentile, because then I think your rents could go down. But
Very
typically,
good.
just everybody relax here. Typically, rents don't go down. Inflation is still up. And when they manage it to a 2% number, which by God's help, hopefully they get too quick so we can get our rates where they need to be, the issue becomes that those rents will still tick up right there. And that's where you want to be.
And you've got that one chart, we don't have it today, but the historical data on rents. And it
Yep.
really is straight up, where values have a little dips, but
Oh,
rents like,
yeah.
whoop.
Yeah, and I like them being more like that, and some of those are like this.
They are.
And I like them like this because they'll just follow up. I learned it the hard way because I've ridden, I don't know how many cycles down real estate. Back when I first started, all of a sudden I woke up one day and went, man, I'm making some money here. And it was just simply because rents had continued to tick up. And all of a sudden one day you wake up, you just been steady, and you're like, wow, this is real money.
Yeah, and you recommend to try to ride out at least 2 real estate cycles,
You gotta
right?
you have to ride out 2 real estate
That's really
cycles
helpful.
to really make any serious money. The biggest money made in real estate is on appreciation. Okay, just so
Yes.
we're clear. But you
Makes
can't
sense.
stay in the game of real estate unless you're cash flowing.
Yeah, that's so
You
good.
have to cash flow to stay in the game.
All right, more real estate questions. Elizabeth, this is a great question too. What is your opinion on investing in real estate with IRAs and Roths? And then a second part to that, is there a percentage you recommend leaving in stocks for IRAs and Roths?
Well, it depends on where you are, right? It depends on where you are in your financial journey. But I would say, first of all, we have one of our coaches, Bill Bronchek, who's a real estate attorney, and he has a tremendous plan that he sets up for your IRAs where what I don't recommend is investing directly from your IRA into a piece of real estate because of the regulations that are put on the laws and rules that are put on the IRA itself. So what you want to do is you want to invest from an IRA into an LLC that would be a real estate company.
That's good.
Let that company purchase the real estate. And if you do it that way, then you have much more flexibility to be able to invest in different kinds of, depending on how big your IRA is. The other thing you can do is you can't really borrow money against a piece of real estate using money directly from your IRA. But if you have the LLC set up and you're investing in that, then you could go borrow money against it and you can leverage your investment, which typically gives you a higher return on your investment.
That's really good. And then does that eliminate the non-recourse requirement, or?
No, it does not eliminate
keeps
the
it there.
non-recourse. To get to non-recourse means that primarily that the property itself is standing for the loan. And true non-recourse loans are usually done primarily on multifamily buildings. FHA still is offering even today non-recourse loans on those, and people work hard to get them. But most banks today, a normal bank, normal lending, you don't really see as many non-recourse loans unless you're already very well heeled in what you're doing. And or in addition to that, the property that you're investing in and find you're getting a screaming deal and they look at it, there are exceptions where they'll do a non-recourse, but you have to be strong financially personally And not because you're signing, because it's non-recourse, but they just want to know who they're working with.
Right.
And then secondly, because the building itself is so strong and you're buying it at such a deal, then they may do that.
That's so good. And then, just so you all know, Bill Bronchick is going to be part of the Wealth Builders Conference. He's doing a main session and he's doing some workshops. He's really an expert in this area.
Yes, he is.
And him, along with our coaches, really help connect you with people too that can get that set up for you,
Yeah.
and even financing for those IRAs and things. That's part of the benefit of the coaching program. All right, we have time just for a couple more questions
Yeah, I
here.
probably
They're really
need to land
coming
the
in.
plane.
All right. Do you have time for one more?
I would do one more.
One more. Barbara, what's your opinion of real estate REITs or on REITs in general?
Yeah, I think you can, the good thing about REITs, which the word REIT stands for Real Estate Investment Trust, and what a REIT, there are, there are good REITs and there's bad REITs, but if you're able and you're able in this day and age to pretty quickly identify, it's not that difficult to know a good REIT that's really paying a good return on what they're getting. And the good news about investing in a REIT is for you, it's very, very passive, right? And so the point is they're the ones that are active in the business. And so they're out there making the money and you don't have to think about all of this. And a REIT, number one, does give you exposure to real estate and it gives you exposure to the real estate market. Number two, you're dealing with people who are professionals. And what happens most of the time is it just gives you the real estate real estate exposure. The reason we talk about investing in real estate yourself personally is because most people that are trying to build wealth or maintain wealth at let's say what I would call is they start getting into the second X, investing directly and personally allows you to leverage your time and ability to be able to increase what you receive, as opposed, because a REIT is more passive. I like to say it this way, I can't control what the person that's running the REIT is doing.
That's true.
Whereas in my own piece of real estate, I can control it. I can buy it, sell it, rehab it, rent it. There's a lot of things I can do with the investment to enhance the value.
So good. Wow, Billy, this has been amazing. And just thanks all of you for joining us. And just a reminder, I really encourage you to come and be a part of the Wealth Builders Conference. This is just a little
Yeah,
intro
I'm excited
to it.
about it. That's right. How many workshops are we having this year? I don't remember.
We have 12 workshops.
12
Plus
workshops.
for the VIPs, another 4 optional ones that
Wow.
are hands-on. So a total
Wow.
of 16 workshops.
Wow, that's awesome.
We've got Colin Carr joining us, Jeff Vanderwall. Chad is doing a session
Mm-hmm.
and he's doing, David Briggs is doing a session. There is so much that is happening. And there's just something about this year. Our theme is such a time as this.
Yeah.
And I really think that is somewhat prophetic when we came up with that theme, because
Yeah.
we are in times that we need to know what's happening. And also, I've talked to a lot of you that are on, and just that encouragement of connecting with people that are like-minded.
Yeah.
There is something about that. So if you can be here in person,
That's the power of it.
we love to see you. You and Miss Becky love to meet people,
Absolutely.
hug your necks. And so try to be here in person. Go to wealthbuilders.org/events. And Billy, any final thoughts today?
Well, I'd just say in this environment we're in, I just want to encourage everybody. I told the employees here this the other day, God's got this. So regardless of what you're facing and what you're going through, we depend on God in these kind of times to help lead us and guide us into all truth. And even those of you that may be facing difficult times in your life right now, I want you to know, if God be for you, who can be against you? And you have to remind yourself of that, especially
So
in
good.
times like we're in.
That's so good. Well, thank you, Wealth Builders family.
Amen.
We really look forward to seeing you the weekend of February 16th to the 18th. God bless you and have an amazing rest of the day.
Bye-bye.